Well, there's only one story in town, which of course is exactly how Mr. Trump, the great orange one, Trumpton, whatever you like, that's exactly how he, I'm sure, likes it. Now, many hours of TV, radio, podcasts, articles have already been dedicated to analysing the psychology of it all, of the tariff strategy that's crashed markets, if a strategy is what it is, and the psychology of Trump himself, which is behind it all and probably behind what may or may not happen next. It's those markets and the crashing I'm going to focus on, but I will throw in a couple of things which occurred to me and which I haven't heard mentioned elsewhere, although I'm sure they probably have been. Firstly, Liz Truss, a big Trump fan you may remember. Now, her market crashing announcements came within a couple of days of coming to power. He's waited a few weeks. She only managed to crash our own markets, not those of the rest of the world, before she was removed or forced out by the sinister mandarins, she would say, who were really in charge of everything. Now, she, of course, was only elected by a few thousand Tory party members, not 53% of the population, as I'm sure Trump would say. But there have to be powers behind the scenes even over there, don't there? Now, the other big flaw I can see in the tariff argument is labour costs. One reason why so much stuff is imported and not made in America or over here is now the fact that Chinese, Vietnamese, other workers in those countries he's tariffing are paid a heck of a lot less. And I can't see those village people style guys that he had bigging up his policies in the Rose Garden going for big pay cuts. Anyway, sorry, that's adding to the noise and speculation. What about your investments? Well, if you're in a medium risk fund, as most are, as of today, the tax year end, the value has fallen by about 10% since the middle of February when it peaked. If you have everything in shares in an aggressive rather than a balanced fund, you're down around 12%. That could all be worse on Monday, as most funds and portfolios revalue at midday. Now, the US stock markets have been hit hardest, and most of the portfolios we recommend have had at least 40% in the US. Some, particularly the lower cost passive or tracker types, 60%, so nearly 2/3. So here are the main questions we're being asked and which you may be asking yourself if your investments with us or elsewhere have fallen as much as I've just mentioned they might have done. Firstly, well, everything's up in the air. No one knows what's going to happen. Should we just cash in everything, or maybe a bit, move to cash until everything settles down, if it does? My answer, no, not unless you need the money now. If we're advising you, we'll have made sure that you kept a good amount in the bank or in premium bonds, just so that you wouldn't have to dip in when things go down, as they always do. At the moment, any loss you've made is a paper loss unless you cash it in. And getting your timing right and knowing when to go back into stocks and shares is really a matter of pure luck and not judgment, unless you have some insider knowledge of events which may trigger an increase in the markets, which some say that some close to the White House may have. You may think that. I couldn't possibly comment. Go online for further conspiracy theories. Okay, next, should we move to a fund which has less in the US, or maybe nothing in the US, or from a passive type of fund into one which is more actively managed, so that the managers can duck and dive and decide day to day where to be and which shares to choose? Well, most of the lower cost funds make their choices about where to invest based on models of what has happened in markets over years, decades, even longer. And all that evidence-based investing, as it's called, shows that staying in for the long term is the right thing to do, and that history really does repeat itself, or at least, as we've said here before, rhyme. Yes, you may say, but surely what's going on now is unprecedented. it's also volatile and up and down, and yes, again, but then the millennium bug and the dot-com crash in 2000 were unprecedented. So was 9/11 in Iraq in 2001 to 2003. So was the global financial meltdown or crash in 2008. The Euro crisis in 2011. COVID 5 years ago. The invasion of Ukraine 3 years ago. And even once again, Liz Truss. But then also, so was Pearl Harbor. So was the oil crisis in the 1970s and Reaganomics in 1987. And those are all things that brought stock market crashes, which seemed at the time like the end of the financial world as we knew it, but now only look like blips in the longer term graph. Any hints and tips then, Philip? Well, yes, if you have money to spare, and I mean to spare, and with all the usual provisos, although I hopefully don't, after all I've already said, need to say that markets can fall as well as rise, you may lose what you put in and so on, but you could be brave and use your stocks and shares ISA allowance sooner rather than later this year, or in the new tax year. Last hint and tip, don't watch the news or check your investments more than once a day, and it will be all right in the end.